Looking at the Markets with David Modell.
Welcome to Looking at the Markets with David Modell. I'm back again with one of my favorite guests, I'll admit it. It's Mr. Seth Golden from the Golden Capital Portfolio and from PhenomGroup.com. So first of all, let's just get right into this because there's so much to talk about with this article that came today. Mr. Seth Golden, welcome back to Looking at the Markets.
Hi, David. Thank you for having me back. And yeah, it seems like every month there's a particular article mentioning me by name or status, and sometimes it's just a good idea to issue a retort of sorts and just clarify things that maybe need clarifying.
Right. You're being very polite right now. I read this article. It's from ZeroHedge.com, and I'll put a link to it in the description below. And that that is not an endorsement of what they said or of ZeroHedge.com. I'm not expressing any opinion about that article. It is just a link to it. That's all it is. You can, if you're watching this, listening to this, you can take it however you will, and perhaps we'll respond with our opinions toward that article. Okay. Now, first, let me say what the article is. The title of the article from ZeroHedge.com, Muir, I guess that's how you pronounce the person's name, says, people are going to be wiped out by short VIX ETFs. And I assume he's referring to the popular ones that Mr. Seth Golden likes to trade off, and he likes to short them, actually. We're talking about UVXY, VXX, TVIX, things like that, all right? And it's kind of interesting. I'm going to read a little bit from this article just to give some background to people who did not have a chance to read it. First, he talks about the fact that the short VIX product trade, people like to short sell or short VXX, TVIX, UVXY. It has become an increasingly popular trade to make because every time these VIX products go up, people short them, and sooner or later, usually sooner, they go back down and people cover their shorts and make pretty good money. It's been an easy trade so far in 2017. Doesn't mean it's always been easy. And I will admit that this article gave a word of caution, kind of like Seth Golden did in last week's video, about how this trade might seem easy, but really it's not. People have not been tested that much. A lot of people who just started doing this trade, and that we really need to take small position sizes and be aware of our risk. Okay, so Seth, is it okay if I just read a little bit of this article?
Please, yes.
Just so we have some background. It's okay. Here it is. I watched a Real Vision interview with John Hempton from Bronte Capital, and he talked about phoning up the infamous Target salesman guy. Gee, I wonder who he's talking about. The fellow that quit his job as a target manager to trade XIV, and that's the inverse VIX, by the way, exchange traded product, to trade XIV and all the VXX products, and he turned his $500,000 into $13 million. The part that really scared me about it was that John phoned him up and he was expecting to talk to this very sophisticated guy. And his basic takeaway was that, and this is underlined, this part in bold, although he had a lot of buzzwords and he understood kind of what the products represented, he didn't really understand his true risk. Wow. Okay. So, Mr. Seth Golden, them's fighting words, as I like to say. So, in peaceful but assertive terms, do you have a response to this article?
Yeah. When I first I just encountered it over the weekend. I guess it was released over the weekend or maybe Friday. So when I saw it, of course, the first thing I tried to do is recollect this phone call with somebody from Bronte Capital, John Hempton of Bronte Capital. I do remember the name because I remember he had followed me on Twitter. So I go back to my emails and I type in his name and nothing came up. And I type in Bronte Capital, I'm using his name and maybe a period, and nothing came up because, in order to get this phone call, he would have to have my direct, line. And I would assume we'd had to establish that over an email. And I just couldn't find any email for that, whether it was my trash box, inbox, sent box. So I have no recollection of this call. I guess that's the most polite way to put it.
Right.
I don't recollect that. Now, so far as me not understanding my risk, I participated in this trade for what's going to be 6 years now. I've done intensive studies on the totality of this complex. I've written upwards of 100 articles on volatility trading, both, from a fundamental standpoint of how these instruments work, what they're correlated to, what contango is, what your risk factors are, from the long side and the short side, and outlining a particular strategy, to limit those risks while, potentially maximizing your return on profits. So it's really hard for me to validate what is being said in that article that I don't understand something. And then when I get into the verb, okay, so first it was 12, in the New York Times article, it's $12 million that I've been able to accumulate, not $13 million. Somebody, and in the article they say I'm a salesperson and I quit my job to do this particular one strategy when that's not the case at all. As you well know, David, and the audience probably knows, I have multiple strategies. I participate in the retail sector and the CPG sector as well as volatility. There's no one strategy that has, gained me that return on profit over the last 5 years. And I didn't quit Target to do this. I've been an investor for now, 18 plus years. Yeah. So I've always been interested in the equity markets, in the bond markets, and in real estate. I do quite a bit of, investing in the real estate market. So all of that has been what has, generated, a comfortable living for myself. So there was a lot about that article that was not, didn't appropriately or factually represent, this trade, my participation in this trade, and my understanding of the risk, because that seemed to be what the article highlighted. This phone call highlighted my lack of understanding of this risk. If I go a little bit further and look at what the cautious, information that they try to disseminate in the article, like I understand that, exercising caution in this strategy or in the VIX trade as a whole is very prudent, and I've outlined that many a times, especially in my last article, as well as our last interview, David. Yep. Caution, experience, having the appropriate resources around you to help you understand your not just your risk, but your counterparty risk and things of that nature. We've talked about that at length. One aspect that they, and here's one of the things where I won't say it discredits the article, but it begs to question the author's understanding or the people that are participating in this conversation's understanding, because they suggest that if the VIX went from 10 to 18 overnight, the participating short volatility players would get wiped out. The instrument itself would also be wiped out.
Yeah.
Well, that happened already. We've had an 8-point move. We've had more than an 8-point move in the VIX in a single day.
Right.
Whether it was 2011, 2015, these products are still here. Yeah. The short volatility players are still here and growing. So it very much, it invalidates their thesis to a large degree using those numbers that they offer. I would say I'm the whipping boy, I guess I'm the, kind of the whipping boy for this strategy. And I'm okay with that to the extent that you put out reasonable information that benefits everybody. I don't know that this was the best, article for achieving that goal, where it actually benefits people, because the math that they offer doesn't work. Historically speaking, we can all see that the math they're using has not produced, the outcome that they say would be produced. Even with the increased level of participation, again, they don't really identify where the counterparty risk is in this trade. They seem to allude to the fact that it's individual or public interest, in the trade, when you have to understand your options, clearinghouse, and they individually price the VIX. That understanding is not in the article.
Yeah.
So there's a lot to desire, in the way of additional information. I fully appreciate, caution. I fully appreciate, telling people, hey, this isn't for everybody. And to some degree, maybe the money has been made, the big money has been made. But it, doesn't mean that you're going to blow up by participating in this. It's all about, like you said, David, position sizes, knowing your macro factors and the risks associated with it, because the VIX is nothing short of volatile.
Yeah.
And how you participate, how you position will determine how well you do.
Yeah. It's interesting that they would claim that, or I'm sorry, it seems to imply in the article, if not stating it directly, that you, or perhaps, okay. The implication is that you're not aware of the risks involved. And you just put out an article last week proclaiming the risks involved, cautioning people, and a video. We did this.
Right.
And I invite people to check out that video that goes on and on for almost, we went on for almost an hour with you talking about,
sorry.
but it was great because you cautioned people that you have to do this the right way if you're going to do it at all. All right. So to have an implication there that you're, and also the buzzwords comment, what contango, is that a buzzword now? Roll yield?
Apparently that's supposed to make, people look intelligent in this trade, but there's so much more underneath the hood, and understanding, how the options, play in this particular strategy. I mean, there's a gentleman that I know and am fond of on StockTwits, and I think he puts it best. There are a lot, more people in this trade, but they're in it based on momentum, kind of like Bitcoin. They're in it based on momentum and what they have seen happen in the past. It's those type of people who haven't taken a good look under the hood.
Yeah,
that's how, his name is Justin McCarthy, I think, and he puts it quite perfectly. There's a lot of new people in this trade that haven't looked under the hood. And don't really understand the correlations that make this trade work or unwind this trade to a certain degree for periods of time. Yeah. And it's those people why I wanted to do that interview with you, and why I wrote that previous article, exercising a note of caution. Because I do see how much more popularized this trade has become.
If anybody has been recommending caution, it's you. And so that's why this article struck me as so, I don't want to say disingenuous, but I don't think it strikes the right tone. That's my polite and highly charitable way of putting my opinion on this article. All right. Also in the article, something kind of noteworthy, it almost seems to champion the idea that perhaps brokers ought to limit people like you and me in our ability to make this kind of trade. It seems very positive toward interactive brokers, according to the article. This is not according to me. This is according to the Zero Hedge article here, stating that interactive brokers has a very restrictive margin requirements.
Correct.
I'm reading from the article now. Brokerages have caught on to this, Muir says. Interactive Brokers, one of the largest online brokerages, is now asking retail investors, that's you and that's me, to post between 300 to 400% margin when they short certain VIX contracts. Supposedly the rationale for this is because it can go against you so sharply and so quickly. But I don't know. I'm just curious about your opinion. Is this a good thing that interactive brokers might be playing mommy and daddy and forcing you to take small position sizes? Is that a positive thing? And would you like to see other brokerages such as Scottrade, TD Ameritrade, and so on follow in their footsteps, or is this overly restrictive?
I don't think the reason or the rationale behind IB's kind of restrictive or increased margin requirements is a matter of, playing mommy or daddy or limiting their risk. I don't think that's largely why they do it. They do have an international audience. And I largely think they're not necessarily the most prolific participant from a brokerage standpoint in this trade. There's far many other brokerage houses that proliferate this trade, like Scottrade, like TD Ameritrade, Charles Schwab, Fidelity, that don't have nary the type of requirements that IB has. I couldn't speak intelligently as to the specific reason, but that they've increased their margin requirements over the last 2-3 months. But playing mom and pop doesn't help them. They're not generating transaction fees. The more and more that they raise the requirements, they're losing transaction fees. They're losing contract fees.
Yeah.
So that just doesn't seem to fit, a logical narrative. I would venture to guess it has something to do with their clearinghouse or, the options clearing corporation that, that they've substantiated and are working with, because limiting your fees doesn't help you as a brokerage in reputation, in revenues, or in any fashion. And I've never heard of a brokerage that is, working, to that, general degree in favor of their clientele. Right. There's something else there. And that may be me, looking too, skeptical about, that situation. But, I'm largely going by experience. And I went away from IB, several years ago because of the way they practice, they participate, with your account in this trade. IB is known for closing out your position. It doesn't matter if you're on margin. It doesn't matter. They, one day you go and all of a sudden it's closed out. You could be in profits, substantially in profits, and it's closed out because, of course, from their perspective, what they want you to understand is that the owner of the shares, wanted their shares back. Okay. It just can't be the case for as many times as they've done it. So, I went away from them a long time ago, not to mention that they just never had any inventory to borrow. So there's a lot of, variables that, you can assign, why they're doing this or why they're, not doing it the way other brokerages are. But there's nothing definitive I could substantiate. And I've, talked to them on various occasions as to, why they're doing this, and it's policy. Or in years past, trying to establish, hey, this is why I'm participating in this trade, and this is why I need my positions to remain open. What can I do as a client of IB, to keep this trade going? And I've never got any response of sorts. So.
Yeah. And this is not a recommendation for or against any particular broker. It's just our experiences. And, you know, it is what it is. But try different brokers for yourself if you're watching this and see what your experiences are, and do your research on every broker. And one more thing in regard to this interesting article by Zero Hedge. They admit right here, the author admits, of course, and this is at the end after all the gloom and doom stuff, of course, it would take a large intraday move to trigger a truly catastrophic spike in the VIX. That's true. But at least one analyst, Bank of America's Michael Hartnett, and I'm going to skip a little bit, believes there could be a 1987 style crash in the early months of 2018. Okay, I mean, do you listen? Do you bother listening to analyst predictions like that? Or if not, you know, how are you preparing for the fact that the S&P 500 has been steadily going up or sideways throughout 2017? How do you predict for how do you prepare for a possibly more difficult 2018?
Yeah, I won't say that I disregard, these types of predictions, or don't at least hear what the analysts are saying. But I take it as a compilation of information. No one piece is greater than the other. It's all collective. And I use it to, basically, model my participation going forward, right. Increased risk factors or decreased risk factors. So yeah, 2017 being, the anomaly year that it was for both volatility and equities.
Right.
I don't expect that same, aspect. I don't expect the markets or volatility to be the same in 2018. But something like a 1987 crash, like nobody can predict. There's little you can do, no matter how you're participating in the market, to protect yourself from something like that. If the market crashes 20%, if you wake up Monday morning and the market's down 20%, everybody gets hurt.
Yeah.
Everybody gets hurt. It's not like just volatility players get hurt, or just equity players get hurt, or just True. Bitcoin owners, participants get hurt. Everybody's going to get hurt. So I don't live in that world of, trying to project or for, predict a, cataclysmic market event. Obviously, if you had done that at the beginning of 2017, you'd still be waiting.
Yeah. And
you'd probably be, losing a huge opportunity where the market is up 15, 16, 17%.
Right.
And for volatility players, short volatility players, those products have done a double, or what have you. The ones that decay have decayed by 90+%. The ones that have appreciated by 90+%. You would have missed huge opportunity. The way I participate in the market is to, take all this collective information, and and I look at the the corporate earnings. I look at the geopolitical factors. I look at the macro factors. If those are all still moving in the right direction, I tend to move along with it. Having said that, I've done, fantastically in 2017. And like I said, I don't expect 2018 to be the same. Right. So more than likely going into 2018, I will, have a curtailed market exposure, regardless of it, if it's my, real estate, if it's my retail equity holdings, or if it's my volatility position exposure. It's going to be curtailed. Why? Because, I want to see how we start. Right. If it, tends to go bad, it tends to, start off bad earlier in the year, and then we recover, assuming all economic, standing is on even ground, we'll recover toward, the second quarter, and going forward. But, I don't want to necessarily have, the same positions on, or the same exposure going into next year, given where we were in 2017.
Gotcha. So we're not going to be, if you go to phenomgroup.com and look at the research there, you're not going to see a lot of top calling. You're not going to see a lot of gloom and doom.
I'm not so that much.
I think you are going to see, especially when it gets up and running, and I recommend people bookmark phenomgroup.com. And also if you'd like to get a membership, you definitely want to contact Seth Golden as soon as possible, because spaces are limited and getting smaller every day. You can contact him anytime by email at seth.golden@coolinksit.com. Look on your screen right now. You can find that. If people go to phenomgroup.com, they are going to find, tell me if I'm right, research.
Yep.
They're going to find a community where people can tap into not only your research, but that of other participants.
Correct.
They're going to find, almost a social network, not very different from StockTwits maybe or Twitter, but more focused on the types of trades that you do at the Golden Capital portfolio. Would that be accurate?
Yes, chat rooms, research and analytics, daily news, daily financial news, daily economic data that comes out. Like you said, if you want to start a financial blog of your own with your own profile and information that you care about, investment thesis that you care about and want to, generate to the public, you can do that at phenomgroup.com. So it's going to be a very multifaceted platform that we hope to grow a large community of users over the years, and we have restricted the participation at the initial launch to 1,000 subscribers, of which now we have I think just under 100 VIP signups left. So the response has been really strong.
Yeah.
There's going to be a lot of features. You can get all your your typical stock tickers, all the stochastics and charts and things of that sorts.
Sure. Maybe you've seen Seth Golden featured in the New York Times. Maybe you've seen his articles on talkmarkets.com or seekingalpha.com. Maybe you visited him on Twitter. His handle there on Twitter is at SethCL. Maybe you've seen him on StockTwits, where he's very popular. His handle on StockTwits.com is at Seth Marcus. So check that out if you haven't done that already. All right, and check out phenomgroup.com. I want to talk about Black Friday. All right. I know you like to shop. I like to shop. We all do.
Yep. It's my favorite time of year.
Yeah. It came and went, and now it's Cyber Monday. So many of these things to look at for the retail trade. A lot of headlines over the weekend said, Black Friday was successful, both perhaps for online and for retailers, maybe brick and mortar. Adobe said that consumers spent, over $5 billion just online this time around. What did you see over the weekend?
So I tried to, when I go out on the, Black Friday, I actually did go out, late on Thanksgiving Day. I went to JCPenney, Target, Walmart, you couldn't go to Best Buy if you weren't already online the day before even. But I, drove the parking lot at Best Buy, Macy's, you name it. I went in where I could go in and drove by where I had to drive by. What I saw was a healthy consumer.
Okay.
And I think that's mirrored in what Adobe Insights offered. But there were winners and losers, or winners and not as much winning, when you compare the retailers. And I've been, very honest. I've done this for a number of years. I know what to look for when it comes to what's on the shelf, how many people are in line, what's their basket size. And I look at all of these things. I don't just go in and go, interesting. I take a very analytical approach because I have a number, I have checklists, that I need to check off this box, for the retailer in order to gauge how well they are doing year over year. So my winners were, when it came to traffic and in stocks, my winners were Target, Walmart, JCPenney. To the extent that I could really only review the line, I would assume it was Best Buy. My loser, kind of my standout, or not winning as much. I don't think they were a loser, but I don't think they won as much, was Macy's. That was the one that I was a little, when I was in the store, and it was only 3 hours after they had opened. So 8, 9 o'clock on Thursday, on Thanksgiving Day, when they opened early, it was about 8, 9 o'clock, and no crowds. There was no crowd. This is South Florida. And this is what a lot of people don't fully appreciate when they hear the headlines. The headlines are always coming from New York, right? They're always coming from New York. They had the CEO on CNBC talking about the crowds he saw at the Herald Square location, you know, and what they were seeing in New York and New Jersey. They're always from that area. The problem with that contextually is half of, if not greater, proportion of the retail sales come out of the Southeast and Midwest. The Northeast is just a little pocket. The Pacific Northwest is also just a little pocket. If you don't win in the Southeast and in the Midwest, you lose, period. It is how it's always been. It's how it likely always will be. So, you know, I was discouraged by the lack of crowd that I saw at Macy's. I was encouraged by their in-stocks. They had the product, they had the doorbusters, they had the service, which is very key, you know, because that's going to bring back customers. So I liked all of that. I just would have liked to see more of a crowd and in the right areas of the store. I wanted to see more of them in apparel, not in the cosmetics, which was, I would say, fairly trafficked, and not as much in the home goods. That's where I don't want to see them, because the margins aren't there in the home goods section. The margins are there in apparel. To the extent that you can sell at full price, apparel gets upwards of 50 to 75% margin in apparel. Home goods, you're lucky if you can eke out 30%. So I always look at that. And I would have liked to see more people in apparel. Yeah. Basket size was decent from what I saw on the lines. So that was a positive. So I would say, like I said, Target, fantastic lines. The parking lots were just packed. Walmart, forget about it. They were a clear winner. It really, for Walmart, it always comes down to how much did they discount, and how much will that impact gross margins, i.e. impact total profitability. But from a sales standpoint, that's where you get your market share, and they're doing the right things to get market share, as proven year after year, and it's reflected in their share price. So that was kind of my takeaway from Black Friday, my anecdotal experience, if you will.
Fair enough. Now, it sounds like perhaps the winners, the biggest winners of all, were Walmart. No surprise there. But Target, okay. Why don't we talk about Target? You recently gave your analytical summary on Target's third quarter performance. But Target's stock has sold off since they issued their third quarter results, 2017, and also their forward guidance. So can you give an explanation of why the sell-off, and then it came back and now it's selling off again, and what's going on here?
Yeah, so the quarter was clean. They beat on top and bottom line. They produced a positive same-store sales comp as well. So from just a metric standpoint, and on top of that, gross margins only contracted 10 basis points. And this is after, this company has outlined since the beginning of the year they were going to invest $1 billion into gross margins, meaning they were going to fight for price and try to, capture market share. And to the extent that they've, worked on that objective, they've shown success, at least for the first half of the year and through Q3. So from a metric standpoint, there wasn't a problem. Guidance is what I think put some people off, because they guided, from the low end to the high end. The high end was a penny above analyst estimates. That's never a good thing to do. When you guide your high end a penny above analyst estimates, it basically says, well, we're just going to put this out there for the sake of being higher than analyst estimates. So it comes it has a negative context to it. But then if you take the rest of guidance, from the mid to lower end, it's still cautious. It says there's some caution there. And then on top of that, the company said that they were going to update sales, how they've been doing through the holidays on January 9th. I have not experienced them do that before. So it kind of makes people, wait, what? You're going to, you're actually forecasting this is something you're going to do, and it makes you wonder why all of a sudden they're going to do that. Yeah. So I think that's a couple of reasons. And then I think the third reason is we're back to the inventory game again. They had decreased inventory by 5% in the first quarter, year over year, decreased inventory in the second quarter, but then in the third quarter they increased inventory by 5%. That kind of fluctuation, it just, it doesn't play well with investors or analysts. It basically says you are not judging your demand properly. Why should you have to turn off the spigot only to, turn back on the spigot, later? There's something wrong there in your forecasting, in your logistics, in your supply lines, and what's going in stores that is making this operation lumpy. Your inventory management very lumpy. So I think that was the third, kind of, negative slant in the results. But nonetheless, I kind of feel that they were being overly cautious.
Yeah. Gotcha. And lumpy is rarely a good word when it comes to retail. So I'm taking notes here. All right. So again, we're not in the market of predicting here. That's not our business. But if you had to give your outlook for this holiday season in regards to retail, how do you think this is all going to turn out for the rest of 2017 and early 2018?
I'm still concerned, when it comes to the brick and mortar retailers. While they're doing a good job of diversifying and capturing sales in the e-commerce channel, I don't know that these early results are going to deviate from what happened last year. Last year we had the same positive news on CNBC and positive commentary from the CEOs of Kohl's and Macy's. I remember Terry Lundgren in particular came out, he had an interview with TheStreet.com saying, basically we're off to a good start. We saw a huge lines outside of the Herald Square location of, 16,000 people waiting online. So we saw all the same comments last year, only to result in some of those retailers pre-announcing and lowering their fourth quarter expectations. Target, Macy's, just to name a few. Yeah. So there's literally nothing new here. And basically, from a lot of people are taking the Adobe Insights, sales characterization as a positive for brick and mortar, and the recent share price appreciation in some of the brick and mortar names like Macy's and Kohl's, and even JCPenney to a lesser degree, as positives that they fixed the problems and they know better how to compete in a online world. I disagree. I believe that the only thing to glean out of or extrapolate out of the Adobe Insights, $5 billion in online sales, which represented, depends on who's reporting, a 17 to 18% year-over-year jump. That online is where the growth is. That's really this has not changed. Yeah. And in order for you to participate as a brick and mortar retailer, you have to spend money online. Macy's used the same numbers as they did last year. The new CEO, Mr. Gennady, said that Macy's saw 16,000 people, outside of Herald Square again. So he used the exact same numbers as he used last year, except somehow traffic increased. I fail to see how 16,000 last year and 16,000 this year equates to traffic increase in stores.
Yeah.
If that's your barometer, which they're admittedly saying that's their barometer,
right?
Why use that same number? You know, something got miscommunicated, maybe.
That's a polite way of putting it, yeah.
Yeah, and last year the same thing with Macy's. Last year, oh, we're encouraged by the, you know, the cooler climate and our reduced inventory position. Well, if you go to Macy's, you know, last year they had reduced inventories by 4.4% or so going into fourth quarter last year. This year, on a comp basis, it's another 4.2%. At what point do you stop reducing inventory? There's clearly a demand problem at Macy's, and the fixes in place are really cutting stores, you know, basically shutting down stores, continuing to reduce inventory to maybe squeak out a better profit, but long term, you cannot cut your way to profitability. At the end of the day, for this business, it's about creating demand. And they have not shown the ability to create demand. Sales year after year have been declining. They're going to decline this year. They're forecasted to decline next year. So while the share price of some of these retailers has improved and may very well still improve, long term, I think these are just trades.
Yeah. Because
long term, there is nothing in these headlines that says any of these retailers has actually fixed the problem or, you know, addressed the issue of capturing enough online demand to offset the in-store, physical store demand.
You've issued so many warnings about JCPenney's, Macy's, Sears, and so on, through your articles on talkmarkets.com, through your articles on seekingalpha.com, through your tweets, through the videos you've done here on Looking at the Markets. I hope people listened to your warnings and to the caution that you're issuing right now. You've hopefully saved a lot of people a lot of financial loss and heartache, and I know you'll continue to do so. So finally, bottom line, because that's what people love in these videos. They love the bottom line. How are you putting your trading and investing capital to work right now?
Trading. Yeah, I mean, that's really, when it comes to these retailers, I don't believe they're investment grade. I think the only thing you can do, and while I'm saying I think, because I think that's the most appropriate terminology,
sure,
the charts validate it. Their fundamentals validate that these are only trading vehicles. And you could get very lucky, you know, and catch the right trade up or down, you know, whichever way. But I would only be trading these, as I have, you know, and I've posted my trades on StockTwits or on Twitter. You know, just last week I took a small short position for a swing trade in Macy's. I thought it got ahead of itself up to the 21.5 level, and you know, I did a short swing trade and you know, did pretty well. And that's another one. I'll do that again on Macy's. Target. I think Target, just because of their business model, having greater exposure to grocery, it gives them a bigger market to go after. So I prefer participating on the long side with Target. That doesn't mean I'll be in a long trade for a long term. Again, that's one that I don't think is going to see multiple expansion. So I only like it for swing trades. And as you've seen, and as I posted on Twitter and StockTwits, I've done that almost 20 times this year, each for between, 1% and 2.5%. Mm-hmm. You add all those trades up and that's substantial.
Absolutely.
So I think for the most part, I'll just be trading these names and look for the opportunities where they get either overextended on the upside or underappreciated from the downside. And, I'll trade them according to that kind of RSI, if you will.
Yeah. As well as all the research that you put into it. We're not just looking at charts. We're looking at fundamentals. We're looking at the macro environment. so on and so forth. And I don't know a whole lot of other analysts and market technicians who actually go into the stores and know what to look for. You're like the retail store whisperer, if you will. Okay.
Yeah, some tricks of the trade are, having worked in retail for a long time, is I know if something is out of stock, just because it just got purchased and maybe the floor hasn't been refilled, or if it's something they're completely out of stock in the back room as well as on the floor. Yeah. It's those kind of things that separate experienced people from just general analysts. Someone like me looks at all these headlines that came out over the weekend and says, wait a second, let's go back to last year and see what the headlines were last year. And that's where I found that interesting tidbit on Macy's. Using the exact same 16,000 people were outside the store last year and saying the same thing this year. Something just isn't right with that, and that doesn't mean that Macy's won't have a good fourth quarter. It just means investors should really, do that kind of research and maybe take some of these headlines with the grain of salt. Don't go full board ahead and, overextend your position. That may not be prudent, right. And you can find that out by doing that, next level of research.
Right. Or you can let somebody like Seth Golden do it for you. Because honestly, if I went into a Target or a Macy's, I wouldn't know what's out of stock or why it's out of stock. I don't have that kind of experience, but you do. And you know what to look for. So people can just, sign up for phenomgroup.com and tap into your experiences, you and your team. And before we wrap it up, how's the timeline coming along for phenomgroup.com? Is it ready to launch pretty soon?
Yeah, so far so good. We're on timeline, for a mid to late December launch. Okay. Pretty much all of the nuts and bolts for the site are complete. Now it's just adding a few applications that we want to make sure are working appropriately, and doing the beta testing to make sure all the applications are from input to response go through smoothly. So we started with 1,000. We weren't just going to cap the initial launch with 1,000 subscribers, and we have less than 100 VIP sign-up reservations left for Phenom Group, and it's at a discounted price. We want to be able to give a discount to the early participants, because once that 1,000 subscriber is used up, we're not going to allow subscriptions until early 2018 at our regular price promotion, if you will.
Gotcha. All right. So people once again can contact Seth Golden at by his email, which is seth.golden@coolingsit.com. Look right on your screen for that one, or look in the description of this video. And once again, on Twitter, he is at Seth CL. On StockTwits, he is at Seth Marcus. Look for him on talkmarkets.com, seekingalpha.com for the latest articles, and phenomgroup.com coming up soon. All right. Well, Seth Golden, I'm excited for this launch of the website, and I can't wait to see how this retail holiday season turns out. I'm hopeful, but cautious.
Me too.
Yeah. But
I always have I have a negative bias. It's because the fundamental performances of these companies, that's what they're producing. Yeah. But I'd love to be able to have a more bullish thesis, and sure. I need the companies to report that to me, though. Yeah. Honesty is the best policy, I think. I'm pretty sure. So there you go. All right. Full disclosure is a good thing. All right, Mr. Seth Golden, we're going to keep track of Phenom Group, and we're going to keep track of what you have to say. I'm going to keep following you on Twitter and StockTwits. And as always, welcome. You're welcome back anytime on Looking at the Markets. Thank you, David. Everybody enjoy the holiday season. Thank you for watching. Please like, comment, and subscribe. And I'll see you next time.